Yeah. So guys, welcome back to my YouTube channel. So we're continuing the class from the beginners class, and also um welcome. If you haven't subscribed, please subscribe, and let's continue. All right, so let's wait for some people to join. All right, you're welcome. You're welcome. We are live. We are live. We are live. Blue. Okay, so let me add your screen so that you can see your screen. Okay, all right.
Okay.
All right, so um we can start now. We can start now. All right, we can start now. I
All
think we
right.
should start.
Good evening, everyone. So my name is Jude, and I'm one of the members of the Era Traders team, Era Traders FX team. And welcome to day 3, I guess, of
Yeah, the theory.
our free mentorship. So I guess you can all see my screen. So I'll be starting from where Anointing stopped yesterday. One of the members of Era Traders FX team. So I'm going to be continuing from where he stops. And remember, this session is majorly for beginners, right? So this is a beginner session, and we'll just be going through the basics of what it takes to be a forex trader and these foundational knowledge that you're going to be needing to be an established and profitable forex trader, right? So without wasting much time, so first off, I'm going to be running through this book. Unfortunately, I couldn't prepare my own slide before this class. Yeah, I was quite busy on stuff, so I'll be going through this textbook to um teach us most of the basic things that were stated here, right? So as a beginner trader, so I'll be taking you through the mind of a beginner, right? Like when I started to how like I view things and what I know now, right? So I'll be in that space. Like I want to get inside your mind as a beginner and put you through, right? Because I know how I felt when I started. I know like the questions I wanted to ask that I didn't know. So I want to get inside that my beginner mindset and take you through, right? So yeah. Let's get into it. Let's get into it. So as a beginner trader, what are the basic things that you should know, right? That you should learn. So the first thing, first off, there's something called broker in the markets. And although this might have been said in the last class, but let me just go through it. So a broker in the forex markets, they are like a third party, right? That connects you to the financial institutions. They connect you to the global markets. So that's the work they do, right? So they serve as a connection, they serve as a bridge between you, the trader, and the global financial markets. So they link you to the markets. That's what the broker does. The broker links you to the markets. And it is through your broker that you take trades, right? You perform transactions through your broker. So um to get the best broker of your choice, you have to do your own personal research, right? Because all brokers they have like different they have different rules and regulations, right? So, like to get the best broker of your choice, you have to do your own research and know what they offer and the benefits one offers over the other. There are millions of brokers out there, right? So, but I think the most popular one in Nigeria right now should be XNex, and that's the one I use to, and that's the most popular broker right now. So I might be using XNex because I'm satisfied with their conditions and their regulations, but you might choose to not use XNex because you're not satisfied, right? As a trader, we are both traders, but we might not be wanting the same thing from the market. So you might not be satisfied with what a particular broker is giving to you, and you're satisfied with the conditions of the other. So you have to do your own personal research to know which brokers can satisfy your need. So there's something also called spread in the in the market. So different brokers have different spreads. So this is the major reason why you should also do your research before choosing a broker. And remember, basically, a broker connects you to the financial markets, right? So yeah. So you have to do your research to get your best broker and know the ones that offer you the lowest spread. So spreads are like a certain amount of money. Basically, that this what spread is like a certain amount of money that your broker takes from you, right? Before helping you to execute a trade. So some brokers also take some amount of commission from you for placing your trade in the market. So they want a percentage of your money to themselves for helping you place your trades in the global financial markets. So so as stated in this book, it says for you to get your broker choice, you have to do some research and use the broker who can satisfy your needs and also offer the lowest spread, and also choose the broker that will pay you without questions, right? Because some brokers also have payment issues one way or the other. So just choose the one that have the best review according to people and don't give you issues while trying to withdraw your money from them. So personally, I use XNex, and I think that's what most traders in Nigeria use right now. It's one of the best at the moment. So another thing you should know as a beginner trader is currency pairs, right? Currency pairs. So there are different currency pairs in the markets. There is as you can see here now, if you can see my watch list, right? As you can see on my watch list, you can see what I have on this right hand side. You can see this clearly. Let me expand it so it will be more clear. So you see all these pairs here. These are currency pairs that you trade in the financial markets, right? These are called currency pairs. These are Forex, right? They are stocks. Although I don't have anyone listed here on my watch list because these are the pairs I keep an eye on. That's why I listed them here on my watch list. So this you have okay. So as you can see here, you have your stocks. You can trade stocks. You can trade funds, futures, forex, and crypto indexes, bonds, economy. I mean, they are just numerals, right? So first off, what is also this website? This is called the Trading View. They have an app, but this I majorly make use of the website on my laptop. So Trading View offers you data, right? They offer you data in the markets, and you can use them. You can use it for free, right? I'm using the free plan, but you can also subscribe for their premium to get a lot more benefits, right? Yeah, so they give you data to the markets, data to each currency pair. As you can see, this is Canadian dollar against the Japanese yen on this chart. So I can connect and see the data. That's what they basically do for me. So they are giving me data to the markets to each pair on different time frames. So these are the time frames I have here on the upper left hand of my screen. So you can see this is 1 minute time frame. So you can get all the data on the 1 minute. They offer me data on, I mean, all time frames, right? 4 hour, daily, can just switch in between to study the market and know the direction of the markets. So, like I said initially, I'm using the basic plan. So they won't allow me to view the markets on the seconds time frame. So they I'll be requested to upgrade to an essential plan or something else, right? To subscribe to their app for me to be able to use that feature. So there are a lot more features that you can use here if you are subscribed to it, right? But for now, I don't really need it, so I just make use of the basic plan. So these are called currency pairs. They are stocks. They are stocks on this trading view. They connect you to different financial markets, right? You can trade stocks, you can trade funds, you can trade futures, forex, crypto indices, bonds, and a lot more. They are just numerous, right? So now what we'll be focusing on is the forex markets, the forex section of the market, and as you can see here, you have different currency pairs. This is how they are always stated. So you have the euro against the US dollar, and there are also different um, there are also different institutions that offers you this data, right? But they are all similar. So this the same pair, this Euro USD from FXCM, and this the same Euro USD from Rwanda. So they are all kind of similar, are similar. So once you start using them, you understand what I'm trying to say here. So in the markets, there is something called base pair, the base currency and the quote pair, right? So now, for instance, um, if you have Euro USD and it's stated this way, Euro USD, you have the euro against the US dollar, and also you can have the Japanese yen against the US dollar, right? You can also have the Canadian dollar against the Japanese yen, like you saw earlier. So this first one you have here is the base pair, right? And the other one on the right hand side is your quotes pair. So the Canadian dollar in this case becomes your base pair, and Japanese yen your quotes pair. So yeah, not to waste time there. As you can see on my watch list, these are all the pairs I have here on my watch list. I'm keeping an eye on. So you have the US dollar against the Canadian dollar, the NZ New Zealand dollar against Japanese yen, and just like that, right? So you have a lot of currency pairs in the market. Yes. So as a beginner trader, so we've talked about the first thing, which is your broker. The second thing we talked about the trading view, right? And how you can use trading view to get data from the financial markets and what they offer, right? And also the currency pairs, what's the offer, like the stocks, indices, commodities that you can trade. And we said we are focused on the forex, right? And how they are being stated as quote pairs and base pairs in the markets. So also as a beginner trader, what is the third thing that you want to understand in the market? There's something called session in the market, right? There's something called sessions in the market. So just like in the school, you have in school, right? You have the assembly period in the school. Mostly in Nigeria, if you're in Nigeria, there's something called assembly in most schools, in most secondary schools, right? Around 8 a.m., students gather together and they do something called assembly. Then you have break time. I mean, there are just different time for different things. So likewise, you have here in the financial market, there's something called sessions in the market. So there are three main types of sessions in the financial markets. So you have the London session, the you have the Asian session, you have the London session, and you have the New York sessions. So and there are times for this section, right? So if you come here to my chart, I want to quickly show you guys something on my chart. So as a beginner trader, I didn't understand what sessions were before, but now, okay. So now, if you come to my charts, okay, let me go to a major currency pair, so you guys can see something. Okay, So here is a major currency pair, right? So now this blue zones you are seeing here, these blue zones you can see here is the Asian session, right? All these breaks, you see this blue zone here, this blue zone, all this blue zone you are seeing here on my chart is called the Asian sessions. So the range, this range in between this blue zone, from here, from here, you can see this range, right? This is a range. This is the Asian range. It's called the Asian sessions, and all the candles in between that is the time for the Asian session. So this is the Asian range. You can see here. So let me state it as Asian range. So this is the Asian range, and this upward section too is also the Asian range. So everything you're seeing that is marked blue on my chart, that box you can see all the candles in between that box. It's called the Asian range. So this is called the Asian range. Now, if you can look closely to my chart, you see this ash line here, where this cursor is. You see an ash line from here to here. This is called the start of the London session, right? So let me quickly denote it. So this is the London session. From where this ash line is to this point. So this will call the London range. You can look closely, you can see, and it's not clear, but if you look closely, you see it. So here also, this is London range. Everything in between there is the London open of the London section. So you call it the London range. Now the second ash line you can see here, it's quite shorter than the first one, is now the last session you have in the market, which is the New York session. New York range. Is the New York range, and the second one also above it. So all the candles you have inside that box is the New York range. So here you have the New York range. Yes, and their strategies, some people, right? They are big traders. Some people, most traders, right? This is the only thing they come out in the market to look for. These are strategies for some people. Just this range, this basic range you're seeing here. Some people just come look for liquidity sweep around this range, and a change of character or a market structure shift, then they take their trades. Right? They just wait for a market structure shift around this range, right, and take their trades. And this is the only strategy they trade in the market, and they are successful, right? This is the only strategy some people trade in the market. This basic thing I've just gone through here, the Asian session, London session, and the New York session. So some people trade only these strategies. They just wait for a session liquidity to be taken out, wait for a market structure shift to the opposite direction. They call it the Asian kill zone. This what that's how it's termed, right? It's termed the Asian kill zone. Now, okay, nice, nice, nice. Now I even have a trade here, right? I had a trade here that I took. Now I said initially that all the sessions all the blue rectangles you can see here is the Asian session, right? Now, although you might not understand what this is, but please just try to catch up on what I'm trying to say here. So some people just wait for this session liquidity sweep to the downside. You see in between this box from okay. So there are times, right? The Asian range or Asian session starts from 1 a.m. right? As you can see below here, this 1 a.m. on my chart, and it ends by 6 a.m. And yeah, right, I think that time in Nigeria we are all asleep. Most people are asleep in Nigeria. So this is most people don't really trade in within these sessions in Nigeria. So the Asian session starts around 1 a.m. and ends by 6 a.m. Now the London section, you see this ash, the range I've stated here, starts by 8 a.m. right? 8 a.m. GMT plus one. That's the African time or Nigerian time. and ends. Okay, this is the London open session, right? Starts around 8 a.m. This London open session. Now the New York session opens. These two sessions they overlap. The London session and New York session overlaps, right? So the London session opens by 8 a.m. and overlaps with the New York session, right? That opens by this is 1 p.m. right? So the New York session opens by 1 p.m. So let me just denote that with a vertical line. So when you go back and you want to check it out on your charts. So moreover, this is an indicator, right? Some people have a clean chart, but I like this session indicators. So I also apply the strategy sometimes, the Asian key zone, London key zone to trade. So they are indicators. You can come to your indicator sessions to okay, this is the Asian range and kill zones, right? You can activate it from your indicator sessions to be showing on your charts. So once you understand the kill zone strategies, you can be using it to take trades. So this London session starts around 8 and ends by okay, sorry, it's London session intersects or overlaps the New York session. So London session starts by 8, then overlaps the New York session that starts by 1, and now the London session closes by this 4 p.m. Right? Yeah, I think they both close around 4 p.m. So this is the close. This red, sorry, orange line you are seeing here indicates the close of both the London session and the New York session. And now the next blue box indicates the start of another Asian session. Now, quickly, let me go through the trade I took here. This was a trade I took. So here you saw the Asian range. The liquidity was swept to the downside. Although you might not understand what liquidity means, but please, just as a beginner, just try to, you know, try to follow up with what I'm trying to say. So this was the Asian range, this blue box. The liquidity was swept to the downside, right? Then I waited for a shift in market structure to the opposite direction, right? Now I indicated a zone below here. I picked an order block, an ICT definition of an order block. So I think if you are around yesterday, we went through what an order block is, right? And the criteria for picking an order block. The first criteria, your order block must sweep liquidity. Your order block must create, they must, not necessarily a must, but these are confluences, right? That if you have an order block, if and you have an FVG, it's like a confluence to indicate the validity of that order block, right? And if that order block would be willing to hold price, right? So this is an FVG, and I think we also went through what an FVG is in the last class. So an FVG is just basically three candles without their open and close touching each other. So this is the first candle here in this case. This bearish candle here. You can see where my cursor is. Then the second candle is this massive bullish candle that pushed and expanded in volume to the upside. Then the third candle is also this bearish candle here. Now, if you look between these three candles, 1, 2, and 3, right? 1, 2, and 3. Between these three candles, you see this wide gap here. You see they are not touching each other. So this is what you call an imbalance in the markets or a fair value gap, right? So this space here between those three candles is what you call an imbalance or a fair value gap. And if you have that above your order block or below it for a bearish order block now if you have it above it, this is a bullish order block. Don't worry, you all get used to these terms as time goes on. So this serve as a confluence to indicate the validity of this order block. So I marked out my order block here, and another confluence was a liquidity build-up or an inducement above my order block. So here I'll mark as my inducements above the order block. Don't worry, the more you familiarize yourself with the market, the more you understand these terms. So this is an inducement to my order block, also serving as a confluence for the validity of this order block. Now for an entry, I took an entry here, exactly at this point. You see, it's cleared this liquidity or inducement, then taps me in, right? So my take profit is going to be a previous high in the market that was from, which is this particular high, this point here. Sorry for using these big terms. As you go on, don't worry, you get used to them. So this is a drawn liquidity, a previous high. So I took an entry here and my take profit was on the previous high. Then my stop loss just below my order block. So here I just made money, right? So I'm risking this 1 to 3.6, right? So I'm risking 1%. I'm risking whatever I'm risking. I'm getting 3.68 times 3.68 of whatever I'm risking in this market. So if you're risking $10, you're getting 10 times 3.68 as your take profits once it hits the take profits. Is that okay? So this is just another basic thing that you should keep an eye on, your risk to reward ratio. So your risk to reward ratio as a good trader should always be above 1 to 2, right? Above 1 to 2. People that use 1 to 1 risk to reward ratio, now I'm risking this 1 to 1 risk to reward ratio. It's more or less like, although people do it, but this I don't do this. As a good trader, you should not also be doing this because most of the time it's seen as you are gambling in the market, right? So a good risk to reward ratio should be above 1:2, 1 to 2, or 1 to 3. Some people catch as much as 1 to 9, 1 to 10, right? So those people you can also be part of those people that are catching that kind of risk to reward ratio, right? So like you're getting times 10 of what you're risking in the market. So you see, I mean, that's a lot, right? So yeah, so these are the basics of sessions in the markets. So that's the third thing you want to understand as a beginner trader in the financial markets, right? So what is the fourth thing that I found difficult to understand as a beginner trader while I was starting out? What is the fourth thing that I found difficult to comprehend or to understand? So okay, okay. So quickly for us to continue, I want to just confirm that you all can still hear me. I want to just confirm that you all can hear me quickly before we continue. I hope my voice is being heard and I'm not just talking to myself. Also, just do a quick confirmation. Please, can you all still hear me? Can anybody hear me? Sorry. Please, can anybody confirm that they can hear me?
Yeah, we can. We can hear you.
All right, all right, all right. So now, what was the fourth thing, or what is the fourth thing I found difficult to understand as while I was starting out as a beginner trader? So there's something called news in the market, right? So there's something called high impact news. They are news of different they can how they are categorized according to how they can affect the financial markets or the volatility of the market. Volatility is a term that explains itself, right? Volatility is like the movements of the market. That's what volatility is. So news affects the volatility of the market. News affects the volatility of the market. So a high impact news will have a it just basically explains itself. Will have affect the markets with will affect it with higher volatility. Now there's medium impact news and there's low impact news, right? So the recommended website for checking the news is the Forex Factory. So forexfactory.com, this is the website I have here. I always have it open, right? for every week. I go through it to know if there's a major financial news for that particular day. So I will know how to plan my trades. Right. You also need to know how to work with the news in taking your trades. Right. As a beginner trader, I didn't know that there was something called Forex factory before. I just get into the market and sometimes I see some massive push, a massive move, and I get scared. So I don't know is news that causes such move in the market. So you can see a move like okay, let me quickly show you guys if you can see. Okay, now you can see something. I didn't take that trade, I didn't take it, but I avoided the news. So as a good trader, you should know when to not take trades, right? Although I caught this buy up to somewhere here, I left early too because of the news. So I didn't want to, be greedy. So as a beginner trader, those are the basic things you should have in your mind. In as much as you are looking at the amount of money you can get from the market, also be looking at stick to your risk management, stick to it. The major reason I left this trade was I got out of drawdown on my prop account, so I wasn't looking for anything more in the market. So I was looking for another setup. Right, I got out of this buy. I was looking for the sell, but then I didn't take it because of the news, so I left it. And you see, I didn't take it, and it went in my favor because I didn't take it. As when I took it, I could have been in a loss. So this kind of massive push, this was caused by news. There was a USD news today, which was around 4 p.m. See, it has happened already. That's why it's this way. See, these ones have not happened from this 8 p.m. It hasn't happened yet. But this was the news that caused that massive move. Sorry, I think. Okay, this was it. Today is 6th, right? So not okay. This was yesterday. So this was 6th today. So this was the news. I think around 4 p.m. Yeah, it was the news that caused that massive push. So as a beginner trader, you should know how to plan your trade for the week. So I already knew there will be news today, so I avoided that sell. Although I took the buy before the news, so I avoided that sell and I avoided a loss basically. So you should know how to work with news to take your trade as a beginner trader. And the website you can plan, you can see the news for the week is Forex Factory. And you have something called the low impact news, high impact, and medium impact. So these red ones, once you see that label red here, or this red folder are the high impact news, then the ones labeled orange here are the medium impact news. You can see medium impact extended, and these are the high impact expected, and the low impact news are labeled yellow, right? So you can use this website to plan your trades for the week and know how to work with trades. So don't worry, over time, as you stay long in the markets, you know how to plan your trades whenever there are high impact news in the market. So, okay, okay. So now, what is the next thing? Okay, so those are just the basic things. Those are the 4 basic things that you want to um understand. Those are the 4 foundational things that you want to understand as a beginner trader. And now let's move on to supply and demand. I think um one of our mentors that took the class yesterday went through this, so I'll just be fast with it, right? I'll be fast with this. I think he went through all of this, the factors you should pay attention to while picking supply and demand. If you go through, you can go back to yesterday's video to get this concept of supply and demand. Also, although I'll also go through it, but I'll be fast with it. And let's see how far we can get this evening. So, what are the factors you pay attention to? You went through all of this yesterday. Did it create an IFC, an institutional funding candle, right? Then did it break structure? Did it break structure? An institutional candle can also be that fair value gap, right, or an imbalance, right? I think this is what they mean here. Then did it break structure or did it change character? He went through all of this yesterday. What a break of structure is, what shift in market structure or change of character. Same thing. Once here a shift in structure or change of character, the same thing. So he went through all of this yesterday. And did it create liquidity before the zone? like I showed you guys earlier in this Euro USD trade, or was it Euro USD? A trade I took. I said all these serve as confluences for taking a trade. Okay, yes, liquidity build up above the zone. Then this is the IFC candle. Then the break of structure. So all these serve as conferences for taking your trades. So he went through all of this yesterday. Please, you can go back to yesterday's video to grasp to get a good knowledge, right, on what all of this means. So I'll quickly just run through it again. I'll quickly run through. So yeah, let's see. So now there are two different types of trend in the markets, right? There's something called a bullish trend, there's consolidation, and there is bearish trend, right? So basically, if you have a bullish trend, you're expecting the markets to be pushing upward. You went through all of this yesterday, so I'll be fast with this. You're expecting market to be pushing upwards, and just like that, right? And upwards continuously. This is what you expect the market to be doing. And if you're having a consolidating market, from the name consolidating, you already understand what this means. So you're expecting the market to be giving you a series of, this is an indecisive market. Although some people still catch some moves on this market, this is an indecisive market. So this is a consolidating market, and it consolidates in between ranges, like you can see here. It's self-explanatory. I'll be fast with this. And if you have a bearish market is just the opposite of a bullish market. So you're expecting a series of um lower lows, right? Retracements, a low, retracements, then another low. Sorry. So if you have a bearish market, it's just the opposite of a bullish market or a downward trend also. So you have retracements, push to the downside, and just like that. So now, what is a break of structure? Right now, you're having a bullish trend, and you see the market making a series of higher highs and higher lows. So once you see this push that breaks the previous high, this is a higher high, a higher low, higher high, higher low, higher high, and just like that. Now you see this high was taken out, right? This high printed a low, and this low made an upward push that took the previous high. Now that is called a break of market structure. Now there was a retracement back to a valid point, and this valid point is called the valid point is what you call your demand, right? So the market retraced back to a demand and pushed upward again and caused another break of structure. He went through all of this yesterday. So he took another previous high. So this another break of structure. Now in a bullish market, you're not expecting the lows to be taken out. In a bullish market, the market is making a series of upward moves. So you don't expect the market to take out the lows, but you're expecting to sweep only the highs. Now you can see it swept the high, retraced to a valid zone. You're not expecting the lows to be swept out, right? Now pushed again, swept the high, and just like that. Now another retracement to a valid point, then you see another push, caused another break of structure, and just continuously in that manner. So you can catch a series of moves once you have a bullish market. You can catch a series of moves. So you can make a lot of money here in a bullish market by just knowing how to the way you make money here right now in this type of bullish market, giving you a series of higher highs and higher low, is by knowing the confluences involved in taking a trade, right? Knowing the confluences involved in taking a trade, and marking out a valid institutional reference point that the market will come back to, right? After this break of sorry for that. After this break of structure, you saw a valid pullback to an institutional reference point, right? So your ability to make money on this market solely relies on your ability to spot this reference point which the market will pull back into before picking up its order to cause the next break of structure. So your ability to make money in this kind of trending market is your ability to spot um, valid institutional reference points which the market will pull back to before picking up its order, and their confluences or their criteria in picking a valid institutional reference point, which he went through all of that yesterday. So I'll be very fast with this. So yeah, and also in a consolidating market, you have the market is giving you a series of market is giving you a series of it's just consolidating within a range, right? Like the name implies, market is consolidating within a range. So the retail traders, I think, have a higher opportunity of making money in this kind of markets, right? So it's very easy to make the money in this kind of markets. Is short, right? Shorting means selling. The market taps into this demand. So here, basically, so each zone you have down here forms your demand, and the zone you have upward here forms your supply. That's all you need in a trend in a consolidating market. So even a layman will make money here because you're just seeing a tap, a sell, a tap for a buy, and just like that, right? So you can also see opportunities like this in the markets. That even if you don't have any knowledge, you still make money in this kind of markets, right? So these are opportunities also for you to make money. So once you see a tap here, you already know this is a demand zone that will hold price, right? Like you have here, this is a demand, this is a demand, this is a demand, right? So this is a demand here, and the up here, this resistance zone here is a supply zone. So once the market taps here, you go for a buy to make money on this market. You put your take profits in the supply zone, and once it taps the supply zone, also you see a valid confirmation as a retail trader, you enter again for a short, right? And you can just keep catching these moves, right? Can be lucky enough as a retail trader. You see enough confirmation, you can keep catching this move till it is no longer valid. So even a layman can make money from a consolidating market, right? Unlike the trending market where you need to know liquidity build up, you need to spotify your, you need to specify the demands, you need to know what institutional reference points are before taking that particular trades. So here you can just make money by identifying your demand and supply zone. So now you already know that a bearish market is the opposite of a bullish market. A bearish market is the opposite of a bullish market. So basically now you have a lower low, you have a lower high, and you have a lower low. Now you have a push to an upside, which is a push to a valid supply zone here. Here you are marking out supplies. So these are valid points where the markets retrace back into valid institutional reference points where the market is going to retrace back to before picking up its orders. So here you have a break of structure to the downside. Now it's just the inverse of a bullish market. You call it a bearish market. So you enter for a sell around these valid points to cause the next break of structure. Now you identify again another valid demand zone. And this is how you make money in a bullish trend, right? In a bearish trend, sorry. This is how you make money in a bearish trend. Yeah. So this is what you have. Yeah. So yes, these are just the basics of supply and demand. So you can go through yesterday's video to understand all of this. Now you also have something called mitigated and non-mitigated supply and demand zones. So now what is a change of character? You also went through that yesterday. So basically, once you're having an upward trend, you're having a bullish market this way. Sorry. something like this. Now the market gave you this. Now you're expecting a pullback to a valid institutional reference point, right? Before causing the next um break of structure. But then you see something like this. So basically, combining the two things you've learned about bullish trend and bearish trend, right? Now this was a bullish trend. You're seeing a series of higher highs and higher lows, and higher lows. Now the market came here and changed character, right? It changed structure. So this is what you call a shift in market structure, a market structure shift, and started giving you a bearish trend. So you're now seeing a series of lower highs and lower low, lower highs and lower low, and just like that, right? So this is basically just what a shift in market structure is. So okay, now as a beginner trader, you already know what supply zones and demand zone are. I think you are just few legs away from making money in the market. You already know how what trading view is. You know what your forex factory is. You know your currency pairs. You know your um, kill zones, your sessions in the markets, and you know how to pick a valid institutional reference point in the markets. So you are just few legs away from making money in the market. You already know what supply and demands are, so you're few legs away from making money in this market. All you need is solid. You need to be solid in your back testing. I mean, practice, practice, and practice. It's better to practice a lot for you to get it right, right? So you have to just make money in the financial markets. So I think from now we can just go through. He already went through what change of character is, so I don't want to go too deep into this. So we can just go straight to the live charts. You can go straight to the live charts. Um, I'll go straight to the live chat. So I will show you some examples of the basic things we've gone through here in the markets, right? So okay, so if you can also go through this book, right? You can go through the book again. So we'll be sending the book to our channels, both our Telegram channel and our YouTube channel. Sorry, and our WhatsApp platform, right? So I think the link will be dropped below in the comment section of this video. So you can join in and make use of this book. I mean, this book have basically everything you need to start out as a trader. Basically have everything you need to start out as a trader. And don't forget, I think this book basically is okay. According to everything I can see here, these are ICT or SMC strategies for use in the markets. So this book is going to put you through. Basically has everything you need, as I can see here. Basically has everything you need to start out as an SMC trader or an ICT trader in the financial markets. So okay, so quickly let's see examples of some basic stuff we talked about. Let's see some examples in the charts. Okay, now I already went through this session liquidity sweep, right? I already went through this session liquidity sweep. And the reason why I took this trade, right? So first off, I saw a liquidity sweep of the Asian session range. You see, now this doesn't play out all the time. Most of the time, why it doesn't play out is when you're having a bullish market, or it might not play out if you have a news. Also, if you have news around this range, it might not play out. And another reason why it might not play out is if you're having a strong bullish or bearish market. If you're having a strong volatility in the market, it might not also play out. So like 70% of the time it plays out, right? It works perfectly 70% of the time. So here I saw a sweep of the Asian range to the downside, right? So I wait for a shift in market structure. Now market was bearish. You can see a series of lower lows. If I go down to the 5 minutes time frame, if I go down to the 5 minutes time frame, session started. Session starts around 1 a.m. You can see a series of um right, lower lows being formed in the market, and just like that, you can see a bearish trend in this market, right? Now gave some form of consolidation around the Asian range, and we saw a sweep of liquidity. Sorry, we saw a sweep of liquidity from a previous low that the market formed, right? So, sorry, you had a low here, then you had a high, then a sweep of that low. Now, what did you see here? As I've explained, what is market structure shift? You can basically see it already, right? You can see what market structure shift is. You can see it already. Like I just explained, you're having a bearish trend, right? You are expecting only the lows to be taken out, not the highs, right? Now you see, you're seeing a continuation sweep of the lows, seeing sweep, continuation sweep of the lows, cutting break of structure continuously. Sorry. So there's a break of structure. So another one here. So basically, this is what some people just come to the market to look out for. They just look out for these kill zones, and this is only the strategy they trade, and they make a lot of money in the market. So now, you had another break of structure here, which was also a session liquidity sweep, and you're not expecting the highs to be taken out, but the high was taken out, which is now a change of character or a market structure shift. So this is a change of character or a market structure shifts. The market structure shifts. So now you indicate a valid institutional reference point where you want this market to pull back into before the continuation of the bullish move. Why are you expecting bullish move? Because you had a change of character or a market structure shift, indicating market is about to go bullish, right? So if you indicated a zone on this leg, you see there was a tap. If you indicate a strong, if you know your confluences well, and you have a zone here, although I didn't take this, right? So the one I took was after I saw this next break of structure. I didn't take the one that caused this change of character. So if you indicate your demand zone correctly, knowing all your confluences that make up a good or a valid demand zone, right? Presence of a fair value gap, sweep of liquidity, which is this, presence of a fair value gap, which you can see, okay, be in between this 1, 2, and 3 candles. You can see a good fair value gap there, right? If I zoom out well, you can see it here. So you can see a good fair value gap, presence of a fair value gap, that's number 2 confluence, and perfect build up of liquidity. So what is liquidity build up around the zone? What may it look like? So there's something called inducements. Okay. So let's say you have something like this. You have something like this, then you had this, right? So if with respect to the demand zone you've marked out, with respect to the demand zone you've marked out, now let's say you had a break of structure before this pullback. So you had a break of structure from a previous high that was taken out, and you had this break of structure before this pullback. Now, with respect to the valid institutional reference points you've marked out, why did you mark out that point? Because probably you saw a fair value gap on this leg, Then you saw that there was a sweep of liquidity, and now the first pullback you have here is called an inducement. The first pullback with respect to the valid institutional reference points you've marked out is called an inducement. Now, all with respect to the points you've marked out, respect to the valid point demand you've marked out, your demand is also your institutional reference points. This is basically how the big banks trade, right? So they pick up their orders around a valid zone. So now these two zones you have here that didn't tap into the demand zone you've marked out. Remember, you if you mark out a valid demand zone, so don't worry. In marking out a valid demand zone also requires you to be well experienced in the market, right? So as a beginner trader, you can. I mean, all you need is practice. Basically, in anything you do, right? Even to be the best student in your class, what you basically need to do is to practice. Practice. I mean, to be the best student in mathematics, you have to practice mathematics, right? So the same thing applies here. You have to just come to your charts and practice these things, back tests, right? You back test till you are getting it right. So this here is what you call a liquidity build up. You see these two legs movements, right? That did not tap into your valid points you've marked out is what you call a liquidity build up above your zone. Now, once I have a setup like this, right? I see a liquidity build up. I mean, this if this serve as confidence for me to take this trade. I mean, it boosts my confidence to take this trade. Why? Because they are valid liquidity build. Inducement is also a form of liquidity, right? So you see, people that got induced here, what do they mean by inducement? These people that got induced here, they enter the market from here, thinking the market is going to go long and sweep the next high to cause the next break of structure. Sorry. So these people that got induced think the market will go long and take this to cause the next break of structure or a draw on liquidity. So the people that got induced think they are going to enter the market from here, probably put their stop loss below here, right? People that got induced, they probably had their demand around here. But you that know what a valid demand is, you know where your demand zone is, and you don't care what the market is doing above your zone. All you want to see are your conferences being marked, inducements marks, liquidity build up marked. That means I am still on the right track. So I take my trade around this my demand zone. So the people that got induced there, the reason why it's called inducements is that they were tricked, right? They were induced into thinking the market is going to go long from here. Then they'll probably come here and put their take profit here, right? Because they're expecting a next break of structure. They'll put their take profit here and thinking the market will just go long and they will make their money around this take profit. But no, they were induced. So the market will give them just a fake reaction. Then you see their stop loss will be taken out, right? The market will give them a fake reaction, then take out their stop losses. Now, also, the people that got into this liquidity, now this is why there's a basic term that people usually say that if you can't spot liquidity in the market, that means you yourself you are the liquidity. So if you're seeing all this, if you're seeing the market is playing around your zone, you're seeing all this madness above your zone, market is just playing with you. Don't be scared. Why? Because you already know what, according to your definition of what a valid institutional reference point is, you already marked it out. So all these are just confluences, and you should not be jumping in into all of this. If not, the market will be hitting your stop loss, right? So I believe you already went through what stop loss and take profit is yesterday. I think you already went through what stop loss and take profit is. So you should not be jumping into this kind of trades, right? If not, the market will be hitting your stop losses. So the people that also jumped in from here also got caught up in the liquidity. Remember, inducement is also a form of liquidity. They got their stop loss was taken out below here. Now, people that also got in around here, thinking the markets will go long. Also, people who marked out their demand zone here, right? They got in here, thinking the market will go and take the previous high. Now they put their stop losses just below the demand zone. Now the market will just play around with them, give them small profits, thinking, okay, the market will come here and take this high. But no, so just give them fake reaction, and boom, to hit their stop loss, right? But now you that marked out a valid zone and you are seeing all of this, you are not moved. Why are you not moved? Because these are just conferences to your zone, right? This just helps to build confidence for you to take this trade around this zone. Now, you that know what a good definition of a valid demand zone or a valid institutional reference point is, you come here and you this was the demand you marked out, and all these people that got induced, you're just happy because you don't care. This is what this is your point of interest in this market. So you came here, and this is where you entered the market from, right? You enter the market from here. Your stop loss was just below your zone, right? You kept your stop loss just below your zone, and boom, right? Because you're expecting a next break of structure to happen, and boom, the market hit your take profits, and you made money in this market without crying for the losses in the market. Now, all these people that entered that got caught up in this liquidity, they are going to lose. Or you that know what a valid institutional reference point is and a valid demand zone. So you mark this out, and all of these people that got caught in are just conferences for you, right? And you get into this market and you make money. So this is it. Now back to what we are saying, back to what we had. So the opposite of this, right? Now the opposite of this, the same thing for when you want to sell in the market, right? The same thing happens just as you can see here for when you want to sell in the market. Now you marked out, this becomes a supply, no longer a demand. Your zone, the zone you marked out after a break of structure or a change of character for a sale becomes your supply. In this case becomes your supply zone, or another valid institutional reference points, which you also call your supply. So first pullback after the break of structure is an inducement, which is also a form of liquidity. Now all of this is called trend line liquidity. Basically, this is called a trend line liquidity. I think he went through what trend is yesterday, and also went through what trend is. So although if you have this type of trend above, sorry, this in this case below your supply, so this serves as a liquidity build-up, and this is where you are still expecting to take your trade from. Don't be a liquidity in the market, right? So here you're going to go short from here. I'm going to go short from this zone, expecting, sorry, so you go short from this zone. Okay, you go short from this zone, and your stop loss just above your supply, and you take profits in a previous high, causing the next break of structure, which you're expecting, or the next draw on liquidity. So all the people that go in this year, you don't care why they're going to eat their SL, then you make money, right? Yeah. So these are all conferences to taking your trades. So now this is for a sell, and for a buy, this is the setup you have, and this becomes a demand zone in this case. So this become a demand, also a valid institutional reference point. As an XMC or ICT trader, that's the term you use for it, right? That's the term you're going to be using for it. So okay. So yes. So now you know the reason why I marked this out as an inducement. You see, I didn't jump on the trade into the trade from this zone. Why? Because I didn't know what inducement as a form of liquidity is. So the people that jumped in here, right? They probably went thinking, yes, the market has started this move. They're going to go long from here, put their stop losses just below their zone, right? Put their stop loss just below their zone. Now they'll think the market will go and clear this old um, high to cause the next break of structure or the next drawn liquidity. But no, See, the market gave them a fake reaction first from here, thinking yes, I'm in profit, but came back because this was just a liquidity. So don't be a liquidity in the market. So this inducement was just a liquidity. Don't be a liquidity in the market. So it came for their SL, and now they got out of the market with a loss. But you that know what a valid demand zone is, you mark this out. Then you came and this was where you went long. You don't care what happened here. This move has not started. You don't care here because you already know what inducement is. So you went long from here and you made money in this market. So these structures, you see this every day in the markets, right? So if you can already know the basics to this, I mean, you don't have to pay anybody for signals to make money. You don't have to pay anybody for any signal to make money in this market. So if you know the basics of all these setups and you practice them, you have to practice them to be good at spotting them out, right? You have to be able to configure your brain to spot these trades out, to spot them, so you know when and when not to take a trade. So I took this trade, right? I took this trade, and yes, I had a good RR, and this 1 to 3.7. So whatever I risk on this trade, I'm going to have times 3.7 of it, right? So depends on your capital and how much you can risk. So whatever it is you are risking here, if you're risking $1, you're getting $3.7, right? And just like that. So whatever it is you are risking, just multiply it by 3.7, and that's what you're getting back. So yes, and these are just the basic elements for a trade setup. Are just the basic elements for a trade setup. So yeah, um, okay, we've already spent like 1 hour on this session, and I think I've basically gone through the basic things you need as to basic things you need to start out as a trader, right? Now, if you even practice this for 1 week, I mean, you can start making money in the market. Just the basic things we've said here in this whole session, and this is what people pay huge sum of money to learn, right? Just the basic things we've explained here. I mean, when I was starting out, also I also paid to learn what sessions are. I paid to learn what time frames are, right? I paid to learn what a broker is. Very funny. I paid to learn what lot sizes are and all of that, right? So I mean, you don't need to really stress about all these things. They are not really difficult. So and we are giving this all out for free. And if you need more of this, if you have any question or you have more questions on what we just said, or you need, just if you just need anyone to talk to, right? You're having any issue, you can message the admins of our group, the Telegram group or the WhatsApp group, and we'll definitely put you through in whatever issue you're having, right? So I paid to learn these things. What Forest Factory is so funny. I paid to learn what all these things are. I paid, right? So very funny. I paid to learn
Yeah.
what pairs
Please,
and major pairs.
also drop your questions. Drop your questions. Ask your questions. If you have any questions to
Yeah,
ask,
if
please ask
you
your
have any
question
question, you
now.
can start that right now. If you have any
I've
question.
seen one. They said, "I demand and supply zone different from other blocks." Have we answered that?
Okay. Someone is asking if demand and supply zones are different from other blocks. No, demand and supply zones are not different from other blocks, right? There's a reason they are called other blocks. It's an ICT concept, right? I don't know if you all know what ICT is as a beginner. Starting out, I didn't know what ICT is, but it's just a concept which I just showed you. The setup I showed you, right, is if you are an SMC or an ICT trader, that's a valid setup for what an SMC or an ICT trader is. All these setups you can see here. This setup you can see here, and the bullish one I just showed you. Sorry, the bearish one, right? So these are other blocks. This demand here, all these demands here, they are other blocks, right? As I that's ICT definition of demand or supply. They basically just call it order blocks. So there's no difference, right? It's just a term for a strategy. So it's an ICT definition of ICT or SMC definition of demand and supply is what they call order blocks. So that's just basically it, right? That's basically it. So here, this is another block here, for instance. This is another block, which is also what, if you cannot recall, like I've been calling it, it's either I call it, yes, I didn't use the term order block. I've been using demand and valid institutional reference points. So it's also called an order block. That's the third term for it. So a valid demand, valid institutional reference points, or a valid order block. Those are the three names for it, right? Those are the three names for it. So yes, there's no difference. It's also called an order block. There's no difference. It's also called an order block. Thanks for asking that question. I
All right, all right, all right. Thank you so much. Also, please keep the questions coming. We need more questions. We need more questions. Ask your question
if you have
now.
your question, you can ask. We'll be sending this book to the group, right? So also the link to the group will be dropped in the comment section of this video. So you can, I mean, this book has basically everything you need. And if you are going through it and you are confused, message any of the team members. We will be glad. I mean, we'll be happy to put you through. Right? We can all be at the top. We cannot make money from this market. It all depends on your ability to backtest, study, and practice. Just keep practicing. It's just basically the same pattern. You can see this pattern. I mean, some people just trade only this basic thing I've told you here, like I showed you here. Only this basic thing, and you make your money. So just your ability for you to practice and go through it over and over again. So yeah, if you have any issue, you can message any of the admins, and we'll definitely put you through. So any other question? If you have any other question, you can keep it coming. If you have any other question, you can keep it coming.
Also, we gave yesterday. I gave some assignments. All right. I don't know if you have you if we did that. That's the market structure for that's the structure for GBPSD, Euro USD volatility, 100, and also V75.
Okay, you mean that was the classwork you gave in the last session, right? Yesterday's
Yeah, yeah,
session.
yeah. Yes,
Okay, you
yesterday's
expect them
session.
to submit the classwork in the group?
Yeah, yeah, yeah.
Okay.
Does synthetic indices like boom and crash work different from currency pairs? Okay, I think I'll answer that. Okay, you like the name implies, it said derive. That means it was derived from, like, it was just derived. It's not moved by anything. Like it's just moving the price action and everything. It's not affected by currency, like by news, like how your GBPSD, when the news comes out, it moves very fast. High impact news. No, there's no high impact news in derive. All right, it's just nothing is moving. It's just moving due to price action. It was derived from currency, but it's not based on any sentiment or any fundamentals. All right, so that's the basic difference. All right, and you can easily trade. um you don't need to be afraid of, okay, sessions. You can trade from Monday to Sunday every day, 24 hours. You can trade volatility, that's your derivative, your synthetic indices, 24 hours. Why? Your currency pairs, there are times that the market is closed, like from um weekends, the markets are closed. Then also bank holidays affect the market too. So those are the basic, like, difference between synthetic indices and currency pairs. I hope I answered your question.
Yeah, that's the best answer to that question. That's basically the best answer to that question. So your
All
forex
right,
market is
please
only
keep your
open
question.
from Mondays to Fridays, and the
Yeah.
sorry, and the derived markets are open 24/7 all day every week, right? So that's just the difference you have between the derived market and the financial markets. So do you have any more questions? So this is a trade I got into. I mean, you can see just basically by able to spot out by backtesting and being able to spot out my you see my chart is so clean. I don't even have to mark out what the change of where the change of character happened, where liquidity sweep happened, and all of that. Right? Why was I able to do this? Because I kept practicing. Right? You see, I before I started this session, that was when did we start? We started around 8 or so. I got into this trade, and this is just an hour, and I'm already making almost 1 to 3 risk to reward ratio, right? So I'm getting times 3 of whatever I'm risking already, but I'm hoping to hold down to this point, this 1 to 7. I'm hoping to take my profit here, right? Yeah. So I mean, if you backtest enough, you'll be able to just spot these patterns out easily in the markets. So yeah, and this is GDP USD. So I mean, this can also be you. This can also be you. Yeah. So I think that will be all for this session. I think this will be all for the session. And
Yeah, thank you so much. Thank you
okay,
so much, June. Thanks so much. Indeed, it was a powerful session. Thank you so much for sharing this to us, and we learned a lot. And also, please, if you have not joined the group, please join the group. And also, if you want private mentorship, if you want private if you want private mentorship, please you can message us, or just join the WhatsApp group and contact us, all right? And we'll just add you to the group, whereby if all you want the recorded videos for ICT or smart money concept, or the synthetic if you want to be trading synthetics, all right? um if you want to be trading synthetics, there's a main there are recorded videos for you, all right? You can get those videos, and all right, you can just watch them and understand this is the V75 bread and butter strategy, all right? So someone asked, he said, please, I understand. Okay, I still don't get how to spot valid demand and supply. So Jojo, I think you help with that.
okay. Sorry, what's the question? Okay, please. I still don't understand how to spot valid demand and supply points. Okay. What makes up a valid supply? Right. Okay. Sorry. Let me go back to what I had initially. Let me see if I can still find it. What makes up a valid? Sorry. Let me see. I did the annotation somewhere. I don't know if I can still spot it here. Okay, so let's quickly just run through it again. Now, I have a bullish market, right? Sorry. So now I have a bullish market. What am I expecting in a bullish market? A series of higher highs, right? And higher lows. Now, I saw this, and this. Okay, now this looks quite rough, right? From what you stated initially. But now just watch out. Now in a bullish market, right? I'm expecting the highs of the market to be taken out, right? So I saw this and I marked this as a break of structure. It's a valid break of structure. Why the high was swept. This high printed a low, and this low printed another high that swept the previous high, or the most recent high, right? It swept it and gave this new high. So here I spot this as my break of structure, right? Now after I had this break of structure, now let's say on this leg, see this leg I have here, this particular leg, you see this where I marked out with this rectangle. Now on this leg, I saw a valued fair value gap. I hope you already know what fair value gap is by now, right? Now I saw a fair value gap here, right? And the last bearish candle, right? Before that massive expansion, the last bearish move, right? I was seeing a bearish move here in this leg, this particular leg. This one gave me a bearish move, right? Before this next one printed a massive expansion that gave that FVG. This next one here, right? Now, the last bearish candle I had here, the last downward push I had before the next candle gave me a massive expansion or a massive volume to the upside that created an FVG, right? Can serve as my valid zone, my valid demand zone. So I'm going to mark it out first off. Remember, the market is still here now. This was what I saw. Remember all of this. Now keep your eye out of all of this zone. This has not happened yet. Where this triangle is, keep your eye out of it. It has not happened, right? Keep your eye out of this zone. Where this, just keep your eye out of here. So this is the only thing you had here, because you had a bullish zone, you had a bullish trend, and you saw a break of structure. Now you saw the last bearish candle before a massive expansion that gave a fair value gap, right? Fair value gap is one of the confluences for a valid demand zone. So you already marked that candle out. You mark the whole candle. That's the last downward candle before the massive upward push that gave the fair value gap. So you mark that candle on this leg. So you mark it out this way. So remember, this box has not happened yet. Now after that, remember you already marked this out. Now with respect to what you marked out, now you've started clicking your confluences to take this trade. The first confluence is already clicked. What is the first confluence? That you have an imbalance or a fair value gap on this leg with respect to the demand you marked out, right? All of this has not happened yet. Where you see all this XXX, this red zone has not happened, but you already have your demand marked out because your first confluence was clicked, which is presence of a fair value gap. So that was marked out. Now, what is your next confluence? Now, let's say now this pullback happened. Now, let's remove this triangle, this rectangle. Let's move it out of here. Now, let's say now, after you mark this out, this now happened, which is this failed pullback happened. So after this first pullback happened, and not you click your number two confluence. What is that number two confluence? This first pullback with respect to the demand I marked out is my inducement. The first pullback with respect to the valid demand zone or valid institutional point or valid order block, which is the three names for it, is my inducement. The first pullback with respect to the zone I marked out, the first pullback becomes this inducement, right? Now, after you had this inducement, my number two confluence was clicked. First confluence, FVG, clicked on this leg. Second confluence, first pullback, clicked. Remember, this XX zone has not happened. Now this one happened, right? First pullback, clicked. I marked it out as inducement. That means my confidence now to take this trade, once it taps on this demand, is growing, right? The confidence for taking this trade now is growing. Number two is clicked. Now, this next one happened. After this inducement, remember, people got induced into this market. What were their thoughts? They were thinking they will enter the market from here, from this, because they are seeing this push. So they jumped in, thinking it to go and sweep this high to cause the next break of structure. That was their thoughts, right? But that did not happen. That did not happen. Instead, it came back and hit their stop losses below here, right? But you knowing this was just a confluence, you held your trade, right? Now this happened. These two happened. Let's say these two movements happened, right? Okay, now let's say this first one happened first. Now this was a clear of your inducements, right? Swept inducements took their stop losses. Swept inducements took their stop losses. Now it has not tapped your zone, which you marked out yet, right? Now this next one happened again. Remember, it has still not tapped your valid zone that you marked out. Now whatever happens above here becomes a build-up of liquidity. Now your third confluence now is marked, meaning full confidence in this is a valid trade. I can take it, right? Full confidence now. But remember, always stick to your risk management. Don't go and say this is a valid trade, then you put all your money into it, then you risk your whole capital. No reasonable trader does that, right? Right? No reasonable trader will risk their full capital just because all their confluences were clicked. No reasonable trader does that. So you stick to your risk management, right? Don't worry. Once, don't worry with time, you understand what I'm talking about. So now this two leg becomes a liquidity build up, giving me full confidence, meaning my three confluences has been clicked to take this trade. First confluence, presence of fair value gap with respect to my demand or my valid zone I've marked out. First pullback inducement was cleared out with respect to that same zone I marked out. Now liquidity build out with respect to that zone. Third confluence was clicked. So that means I have the full confidence to go into this trade. So now I put my buy limits. I don't know if what buy limits, sell stop, sell limits was explained in the last class, but I think we can basically just go through that in the next session or so. So I put my buy limit here, waiting confidently that once this zone is tapped, I want to see the next break of structure happening. I want to see the next break of structure happening, right? So this becomes the next break of structure, or it's also called a draw on liquidity. A draw on liquidity. So this is where I'm going to enter this trade from. So this is how to spot a valid order block or a valid demand or a valid institutional reference point, right? So I hope this answers your question. So I enter my trade from here. My take profit should be just where the previous high is. Why? Because I'm expecting liquidity on that high to be swept out, or because I'm expecting the next break of structure. Why am I expecting it? I am in a bullish trend. Is that okay? So this is basically what you have here. So now for a when you are in a bearish trend, you are seeing a series of lower lows. Basically, this now becomes it just becomes this. So I mean, if you know this, you're already like you're just few legs away from killing it in the markets. I mean, making money in the market. You're just few legs away. All you need is just what practice, practice, and practice. So for a sell trade now, this becomes your valid supply in this case, and no longer a demand. So this becomes a valid supply or a valid order block for you to take your sell entry. All your confluences were clicked, fair value gap, inducements, liquidity, cleared out, tap your zone, and dips. Right? So this is how to spot a valid order block in the markets. So I hope this answers your question. I hope this answers your question. I hope this answers your question. So do we have any more question? Already 1 hour
Thank you so
and
much,
30.
Jude. Thank you so much, Jude.
Yeah, yeah.
Thank you. We thank God for tonight's class, and it was success. And if you have any other question, you can send it to the group. All right. But for tonight, we're done for tonight. Thank you so much for joining. Thank you so much for joining. we appreciate. Please like, share, subscribe.
Thank you. Please like, share, and subscribe to this channel. We are giving you guys, massive, great content. I mean, so if you want to be a profitable trader this year, make sure you follow up on this channel. We'll be giving you guys updates, and make sure you join our groups, our Telegram group, our WhatsApp group. And if you have any question, we are always available to attend to you. We are always available to attend to you. So thank you all, guys. Thank you all for joining. Thank you, and thank you.
Thank you. Thank you.
All right.
See you tomorrow.
Yeah. See you tomorrow. I think the same time. We'll start by 8 to 8 p.m. So see you all tomorrow.
Yeah.